Dear investor, after a fall in September, markets had a comeback in October. November has been a month of consolidation. Markets continue to be focused on India fundamentals as it is the domestic money which is the key driver of the markets rather than global happenings. Globally, the month of November has had a good set of news. COVID restrictions were relaxed for a time in China. European gas prices were lower, logistics costs seem to have come down as well, and inflation numbers were good, and it seems like the Fed may pivot. However, the chair may be a tad before time. I think let's wait and see the policy response rather than assuming that it would pivot. One question that we have been receiving is about the impact of global recession on Indian economy and Indian markets. Let me share a few thoughts on this topic. This is something which is difficult. Let's look at it this way. Indian exports are around 18 to 19% of the economy. A 2 to a 3% slowdown in the Western world, I mean, to my mind, the worst case kind of a situation. Our major markets, the Western world may ultimately result in an impact of 0.5 to 0.6% drag on Indian economic growth. Even this estimate may prove to be large, given that our largest export to the West is of software services, which is an order book driven business, and once orders are received, the executions are usually time bound. The impact on this count hence should be muted. However, there is a chance that the West does not see a slowdown to this extent. Now, the other way we can evaluate the impact is through the lens of trade deficit. This is where it gets difficult and more interesting. A slower world growth has resulted in lower commodity prices. On a yearly basis, most commodities are now showing a fall in prices. Oil, after the crack that we have seen over the past few days, is also now sub 90 levels. USD 10%, $10 fall in the price of oil is a USD 12 to 13 billion saved for our country. Now, here on the other hand, if we get strong global growth, if there is no recession, China comes back, China starts to grow, it will have a strong positive impact on the price of commodities, particularly oil, given that today the supplies are very tight, and this may impact India negatively. Now, the other point here is that obviously if our export markets close slower than us, then our already large trade deficit would become larger. So, in some manner, these are the two conflicting forces at play here. To my mind, it may be best to track the level of the forex reserves, which happily have been increasing over the past month. Forex reserves have acted as a dam against the volatility in the external world. If forex reserves are high enough to finance 20-year current account deficit, as yet we believe it is over 4 years that our current reserves can finance, we can sustain business as usual conditions within the country. We believe we are comfortably placed on this count. A small drag on growth, we spoke of 0.5 to 0.6%, can be countered by the cyclical tailwinds the country enjoys. Consumption, which is a larger part of the economy and has been the growth driver, could increasingly see capex help it and keep growing. Capex could start to provide competition to consumption in terms of growth, in terms of driving growth going forward. Indicators such as capital goods imports, industrial consumption growth, etc. remain strong. Capex should sustain given the healthy corporate balance sheets, improved profit margins, strong banking system with low NPAs, growth-oriented policy making. We are seeing PLIs, we are seeing good support on import duties from the government, and of course, the need for Capex is there with improved capacity utilizations. European energy prices have moved up. Higher outsourcing by European nations may help as well on this count. Government policy direction remains growth oriented. As we speak, we have signed a trade agreement with Australia. An agreement with UK may also be signed soon. People expect it to be done before the end of December. At the same time, as the forex levels increased, RBI injected some liquidity into the banking system which was showing some stress on liquidity is now much better positioned. So this makes us think that we are a country where growth is necessary. People still want employment, unlike the West, where while jobs were there, people were not giving their services. Our situation is very, very different, and growth-oriented policy making should be expected to continue in this country. Moreover, financial 24 should experience strong push via higher government spending, given that it would be the year before election. This almost always happens. This again would support domestic growth and help address some impact of global slowdown. Now, coming down to the next topic, which is the Q2 result season. Well, the season has ended. The season was stronger than expected on profits. Overall for the universe of over 200 companies, earnings declined 5% versus an estimate of 16%. While for Nifty, earnings were 9% growth versus expectations of close to 0% growth. So overall, much better. On a 3-year basis, going back to pre-COVID levels, the universe and Nifty have seen 18 to 19% profit CAGR, which is pretty strong. Continued strong performance in BFSI and lower than estimated losses in OMCs drove the beat. As expected, metals and oil and gas reported sharp declines, 67% and 29%. And excluding these, the universe and Nifty posted a solid 30 to 33% earnings growth, a tad better than expected, yes, driven by BFSI and autos. Amongst other laggards, cement and healthcare figured. Economy has opened up and costs have come back. Also, the higher cost inventory which was carried forward from Q1 impacted performance in Q2, as this was consumed in Q2, and impacted EBITDA margins, which fell by 5.4% overall to 12.8%. Going forward, as we move to Q3, we do expect margins to increase on this count, because now the inventory would have reflected significantly lower price levels. We noted that practically all industrial commodities barring oil have declined sharply. Even oil on a sequential basis has declined. For H1, overall, Nifty posted a growth of 15%. With a stronger performance by India Inc., the EPS estimates have been raised after Q2 results. For financial 23, it should be now closer to 840 levels, and now for financial 24, we should end the year between 950 and 1000. Hopes are now closer to 1000 again. Q3 results, just a few points there. One point is that the margin base effect should play out, and we should see stronger margins in Q3. Second, a significant part of the festival season this time around came in Q3, and that should help Q3 numbers on a YOY basis versus last year. So this was on the results. Now we continue to expect strong alpha generation in future. Alpha is the excess return that an actively managed fund delivers over the benchmark. The possibility of alpha generation improves if the breadth of earnings is good. Breadth of earnings, which was narrow in the past, is now widening for sure. From COVID lows, the large cap provided the first impetus. The baton is now passed on to the mid cap part of the market. That part is now relatively doing better. And as the economy sustains its growth momentum, micro caps and small cap businesses should start to see growth going forward. I think this thought would gain some traction as the stronger government spend that we spoke about starts to happen in the next fiscal. Second, alpha generation requires new sectors to grow for a long period of time. I mean, these sectors are typically not part of the indices, and that helps active managers. Now, themes like China plus one, chemicals are a big beneficiary there, defense on import substitution, engineering on capex growth and maybe European outsourcing, ethanol and PLI beneficiaries. I mean, those are two government policies, etc. Continue to provide strong growth visibility in many spaces, some of them new and emerging, which then means that if the earnings stay strong in this space, the market would follow earnings as it always happens and enable managers who take deviations from the index to deliver alpha. That continues to be our thought. Motilal, which is very strong on ideas kind of a house, on this count is very well positioned. Next thought is the breadth of the market is further improving. India is young, yes, but India is growing old as well. This is something that we are noting. The number of people over the age of 60 is now increasing at a faster pace than any other age cohort. So while the numbers are still small, but the rise is rapid. In fact, the growth of in population up to the age of 20 is quite stable, in some manner even declining. This trend is expected to accelerate as we move forward. Now, this trend should further broaden the services offered in the country. So yes, the services, the goods that the younger population desires will continue to be in focus. That's a part which will continue to grow. But the services and stuff that the older population, the seniors require, would also start to find large traction. So, for example, services for the elderly like medical, like medicines would score high on this count. India is already the pharmacy of the world and produces the cheapest generic medicines. Government of India has extended PLI scheme for the APIs that are not manufactured in the country. This will support the ecosystem of medicines in the country. Over time, we have seen this space create a lot of wealth. Now, similarly, the services part, the hospital services, they are getting better up to Western standards, and while the Indian patient base will provide a lot of business to the corporate hospitals, there is a good case that even foreign patients come to India for treatment, given that our costs are a fraction of Western costs. This is opening up very interesting opportunities for the segment. Our portfolios have a decent representation of this theme, and we believe it will do well going forward. Coming down to valuations, the past month saw the end of a relatively good earnings season, good in the context of expectations. Earnings estimates improved at the end of the season. Globally, also there is some good news. Inflation data seems to be getting better, and there are hopes of a Fed pivot. Indian economy continues to be robust, and the capex cycle continues to remain strong. Now here I will just want to make one point. Inflation is bad is a thought that everybody has, but we need to segment out inflation. Inflation which improves the competitiveness of domestic economy is good. However, inflation which is on account of goods that the country imports is probably not good. So, for example, if oil prices increase in the Middle East, for India it's a higher cost. We would want it to be lower. For India, very clearly, supply disruption driven inflation or inflation on account of commodities like oil is bad. However, since we produce agri products and we are net exporters of the same, and a large section of the economy is employed in that space, higher pricing of agriculture products is not bad. It may be actually good for the nation as a whole. Similarly, inflation on account of movement of business away from China is also good. Okay, this allows some profit margins to domestic manufacturing base. China is the cheapest place to manufacture. It caused disinflation globally. Now that resulted in a margin squeeze in this country. If people adopt a China plus one kind of policy, globally it may be tad inflationary, but India, which is now presenting itself as a good second source, for us it would mean some amount of margins, it would mean more employment, and overall this is something which is good for the country. In fact, India Inc. had seen a sharp dip in margins over time, and we are seeing margins recover now, providing tailwinds to earnings. With better data, while sentiment towards equity has improved, our thoughts on valuations remain the same as we shared last month. We do expect the market to consolidate for some more time, given that bond markets seem to be relatively better poised at this moment. A few months of consolidation or a fall in bond yields would make equities relatively attractive again. That said, we do believe equity markets are positioned in a sustainable manner when looked at valuations of India with respect to our own past 5 years to a 10-year kind of period. In this situation, however, our portfolio is positioned, well, as explained last time, our house is focused on spaces which have participated to a lesser extent in price compounding versus profit compounding, while offering high quality character. We believe this space, this positioning offers much better risk reward equation towards delivery of preservation of capital and growth objectives. More so as a part of a diversified portfolio. So while one or two names can be more volatile, the portfolio approach should diversify away a lot of that risk. We are an equity focused house and our portfolios demonstrate our conviction. Investors should note that now our portfolios are mostly close to 30 stocks. We were with a slightly larger number of names in the recent past. These have been brought down. Meaningful weightages now are seen across the portfolio. They would see our portfolios getting more balanced on sizing as we go forward. Sector representations would also improve going forward. Sectors which are large, have a large presence in the index, would at least have some presence in our portfolios and permit much better preservation and a smoother ride for our investors. We are striving to make our portfolios more balanced for the risks that we are able to identify, to ensure a sustainable delivery of performance to our investors. This is very high on our priority. We would urge investors to track our performance on the mutual fund side, and as data comes on the alternate side as well. With this, thank you everybody. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.